Thank you all for joining us today, and welcome to the Cornerstone Wealth Economic Outlook and Market Update. Happy 2025, everyone. Hope you all had an enjoyable holiday season, and how can it be we only have 333 days left to the next? I'm Jeff Carbone, Managing Partner at Cornerstone Wealth, joined today by my partner and our Chief Investment Officer, Cliff Hodge. Cliff, thanks as always for your time, the energy, and everything you put into putting these webinars together. Today, we're going to take a look back at 2024. We'll look at the themes for 2025. We'll take a look at the Cornerstone dashboard, and certainly we'll take a look at what we're watching on the investment side from the consumer, inflation, labor market valuations, Trump 2.0, the public markets, private markets, and we'll wrap up with investment positioning. Well, 2024 surprised many. After a strong 2023, the market gains continued. We were anticipating, or most anticipated, a bit more of a muted return in 24, but that was not the case. The Mag 7 continued its romp towards strong market gains. They made up over half of the 25% that the markets earned from the S&P. The Dow also had a strong year, being up almost 15%, and dividend-paying stocks were up around 17.5%. As we looked at valuations, they do remain stretched, and even further prompting thoughts of overpricing. Despite this, the market conditions continued to really be strong as they lower their debt and look to improve efficiencies across the board. These are not the same high valuation periods we have seen in the past. Value and dividend-paying stocks also performed fairly well. Even though those tech stocks were stretched, we're starting to see a more broadening in these gains, emphasizing the importance of diversification. As we look at the bond market and the fixed income, continued to be a challenge. That persistent inflation dampened much of what was anticipated as rate cuts were coming down. Bonds didn't do so well overall, only performing at about a 1.25%. As we move over to the international and the global markets, they really continue to underperform as well. As wars between Russia and Ukraine continue, the Mideast tension with Israel and Hamas continuing its course, the MSCI was only up about 5.6%. As we look to the Federal Reserve, the insight of looking at that 2% inflation, the target they were looking for was a tough one. We did get 4 rate drops in the 2024, but at the end of the year, the year-end meetings from the Fed did look to provide some additional guidance going forward. Where we were anticipating 4 rate drops, we're now looking about 2 in 2025 and 2 into 2026. A little bit of a change. Well, Cliff, I think I've teed it up for you. Lots to go over. I know you're going to have some charts that you want to share. So let's take a look back at 2024 and look at some of the themes in 2025.
Yeah, thanks, Jeff. A lot to do, so let's get started with a review of 2024. So as Jeff mentioned, we'll start with a brief review of 2024. And as you'll see from the data on the left-hand side of the slide, 2024 was by and large a really great year, Goldilocks, if you will, from a macroeconomics perspective. Real GDP growth came in slightly less than what we saw in 2023, but was still very strong, supported by the consumer, supported by government spending. Inflation continues to tick lower toward the Fed's 2% target. Very solid growth. Mediating inflation is by and large a pretty good environment for equities, as we can see from the earnings growth of the S&P 500 up year over year, roughly 9%. And then we look on the right-hand side, that translates into some pretty solid returns across the board in the equity market. Start with the S&P 500 up 25%. As we'll see, much of that was concentrated for the second year in a row in the Magnificent Seven stocks, which accounted for about 55% of the overall index's return, and roughly now about 40% of the overall market cap of the S&P 500 is concentrated in the top 10. International, solid year, not as quite as good as the U.S. Really been a story of U.S. exceptionalism, which we think is likely to continue into 2025. and somewhat of a lackluster year for bonds. Though, interestingly enough, the more risk you took on the fixed income side, the better. As you see, high yield corporates were up over 8%, whereas investment grade corporates, which are a higher credit quality perspective, were only up about 2%. But overall, very solid year for markets in general, as we can see from the slide. So then going on to the next slide, we're going to look at the predictions, how well Wall Street did at the end of 2023, projecting forward to 2024, and then what that may have in store for markets in 2025. And the major takeaway here on the consensus expectations front for 2024 was that no one was bullish enough. We ended the year slightly below 4,800. Again, this is back in 2023. The market consensus was projecting a year-end price target of 4,800. And in reality, we ended the year closer to 5,900. So Wall Street was on the wrong side of the trade with just being bullish as they could have been and what actually happened in reality. And then we look on the right-hand side of the chart about the game plan for 2025, where now Wall Street is expecting a year-end price target of about 6,500 on the S&P, which would be a year-over-year increase of about 9% from where we are today. So the street is expecting another good year for stocks. I think as we'll see as we get into the outlook and what some of the challenges are, why we think that could be a little bit of a stretch. But overall, we do expect to see positive returns both for equities and fixed income in 2025. So now we'll get into our investment themes for 2025. And from a macro perspective, we still see a continuation of solid economic growth, slowing inflation, which is exactly what we want to see and what the Fed, more importantly, wants to see from a macroeconomic perspective. We do think that U.S. economic exceptionalism is going to remain intact. We think the consumer will still be able to buoy the overall growth in the economy, though perhaps not to the same degree as what we've seen in 2023 and then in 2024. On the inflation front, we have gotten some pretty encouraging data here over the last few months, and we do anticipate that inflation is going to continue to slow toward the Fed's target, and we're actually looking for a little bit more of a deceleration in the inflation front than what the market is expecting, predominantly driven by shelter and rental inflation, which has been really coming down pretty rapidly. Forward-looking indicators continue to point to that direction. One of the key themes that we're going to be watching from a macro perspective in 2025 is the labor market. And we've been talking about that quite a bit on a number of our webinars and in calls with clients. So far, the labor market is holding up quite nicely. The unemployment rate is holding in at about that 4.1, 4.2%. That is going to be the key to make sure that we can continue to hit those economic numbers, that earnings come in as we expect, and that we can have a nice year in the form of returns, all going to be dependent on the labor market. But while the macro looks good from a headline level, there are some concerns. There are really three areas that have our attention outside of the labor market. First and foremost, valuations are extremely high and remain unattractive, especially in public equity markets. Expectations, whether that be for economic growth, whether that be for earnings expectations, are also quite elevated. And then last but not least, policy in the form of Fed policy and the new fiscal policy from our new administration is going to be a big driver of what happens in the macroeconomy and the markets in 2025, for better or for worse. As we think about all these factors and what investors should be thinking about, where are the opportunities, what are some areas for consideration, one of the areas that we are really leaning into for our clients who are comfortable with introducing some illiquidity into their portfolios are private markets. We think in the public markets, returns are likely going to be somewhat moderated in 2025 compared to 2023 and 2024. And there are some really interesting opportunities in areas like private credit, private real estate, or even private equity, which we think can compete quite nicely with the overall returns of the equity market and can add a good bit of diversification for investors who are comfortable, again, introducing some illiquidity into the portfolios. As history shows, there is a premium for illiquidity, and 2025 is going to be a year where we really want to lean into that. Longtime Cornerstone clients are going to be familiar with our dashboard, and this is what we're showing here on this slide. The dashboard is the three-legged stool of our investment process, if you will, where we focus on the macroeconomy, the fundamentals, and then sentiment or behavioral indicators. And this is really the crux of what we do on a day-to-day basis from the investment perspective. And as we look, we'll see quite a bit of variation across the board. So from a macro perspective, things largely look pretty good. We are moving later into the economic cycle, but we're not currently worried about a recession in 2025, at least in the first half of 2025. The economy remains robust. Growth is strong, powered by the U.S. consumer. Inflation continues to come in toward the Fed's target at 2%, which is exactly what we want to see. And the labor markets continue to be quite resilient, though do seem to be softening up when we look at some of those leading indicators. From the Fed perspective, we went from the most aggressive hiking cycle that we've seen in about 40 years to now in 2024, the Fed cut 4 times, and the market is anticipating another 2 cuts in 2025. So we will see. There's a little bit of concern about whether or not they're going to be able to execute on those rate cuts. Inflation is going to be something that may or may not prevent them from doing so. But overall, pretty neutral from the Federal Reserve. Really, the issues really where the concerns potentially lie are in the valuations and around expectations. As we mentioned to kick off the call here, those are both very high. And there is a lot of uncertainty that has been introduced into the markets, whether that be from the new presidential administration, threats and new entrants in the AI markets. But there's a lot happening and a lot that we as investors need to be aware of. So now let's zoom in on some of the macro data. First, we're going to look at GDP on the left-hand side of the chart. As you can see, growth remains quite robust, powered by the consumer, highlighted there in the gray bar, and highlighted by government spending. We do think that both of these components of GDP are going to continue to be tailwinds, especially the U.S. consumer, while government spending is likely going to be a little bit of a headwind into 2025. As you can see, expectations from a growth perspective on the right-hand side of the chart are elevated. This is the first year since 2022 where consensus has expected more than 2% GDP growth. So that bar is quite high, whereas coming into last year, bar was quite low, had a lot of room for upside surprises. We think that's going to be a little bit more of a challenge in 2025, though very, very robust GDP growth appears to be in the cards. So then we'll look at the inflation front, and really good news on the inflation side is the most recent print in December indicated another month of deceleration, really powered by lower shelter costs or housing costs, which have been a big focus of the Federal Reserve. Inflation is really one of those things where we are continuing to be on track, though most recently there have been some upside surprises in things like the ISM Services Prices Paid Index, which we highlight on the right-hand side, has tended to be a leading indicator of inflation along with wage growth. Going back to our comments about the labor market, those are really going to be in focus for us in 2025 as what neither us nor investors nor the Fed really want to see is the inflation problem beginning to reaccelerate. So far, we've been on the right trajectory. We've had really hot data, and there are some concerns in the markets that inflation could be starting to reaccelerate. We're not worried about that at the moment, but that is a risk that we're going to continue to monitor in the year ahead. And I've mentioned the labor market already a couple of times in our discussion today. But really that print in December got the market's attention, where we've actually started to see some signs that the labor market could beginning to reaccelerate, both in the form of higher than estimated non-farm payrolls and a higher level of job openings, which have been one of the typically leading indicators of the labor market that has been showing some deceleration. we got a really nice print at the end of the year, which may indicate that the economy is more resilient than the market expects. And thus, that has started to get the attention of the Federal Reserve, which, as we'll see on the next slide, has really changed their forecast for policy in 2025. So the combination of the strong economic data, the inflation results, and the labor market have gotten the attention of the Fed. And really, they made a pretty strong course correction in their policy plans in the fourth quarter of last year. As we see on the left-hand part of the slide, going into the September meeting, they were expecting 4 full rate cuts in 2025, following 4 rate cuts in 2024. That changed pretty dramatically at the December meeting, where they removed 2 cuts from the path of their Fed funds projections, as seen on the right-hand side in the dot plot. And if we look, the dot plot is charted with the green line and the yellow dots. What the market expects is actually less than 2 cuts now in 2025. And that's really one of the reasons why we've seen such strength in interest rates and thus weakness in the bond market, is that the Fed is waking up to the possibility that the stronger economic data that we've seen, a more resilient labor force, coupled with new pro-stimulative policies from the new administration, could actually cause things to overheat. And so that's really what's going to be the crux of the path of markets in 2025, is whether or not the Fed is able to continue on their easing cycle. The economy is going to be able to remain strong and resilient without seeing that inflation reacceleration and overheating, which is similar to what we saw in 2022. So for now, the Fed is keeping things tight. They're observing and monitoring the incoming data. We'll just have to see how it plays out, especially as to whether or not the new administration gets a lot more aggressive with their tax, trade, and immigration policies. So then we switch gears and look at fundamentals. And as always, we'll start with valuation. And as you can see on the left-hand side of the chart, valuations are still extremely elevated. And on some metrics, they are at the highest levels we have seen outside of the dot-com peak in late 99 and early 2000. The U.S., we are at roughly 22 times earnings. As you can see on the right-hand side of the chart, a lot of that is going to be concentrated in things like technology, consumer discretionary, where a lot of these large cap growth in AI stocks are. Outside of the U.S., valuations are certainly a little bit more attractive. You look at places like the international developed markets at 15 times earnings, very nice discounts outside of the U.S., though we are, these markets have been challenged more from a growth perspective. And so we are starting to lean in a little bit more on the international side with some of our managed portfolios, but we're not really in a huge rush to go out and go overweight international at this point until we can get some more clarity on President Trump's new tariff policies and get an understanding of how that's going to affect our trading partners. But one of the reasons why we think public markets could be challenged over the next couple of years is if you look historically, valuations have been a pretty big driver of returns, not necessarily on a short-term basis, which is, as you see the chart on the right, at 21 and a half, 22 times earnings, you get returns, return years all over the map. At some levels we've seen positive 40% return periods down to minus 30. So very high variation over a short-term time period. But the longer you go out, we're looking at 5 years on the right-hand side of the chart, and the dispersion's even tighter when you look at a 10-year period. Valuations are a big driver of returns over longer term periods of time. And so at these levels, we think equity market returns are likely going to be a little bit more moderate than what we've seen. Not that we're forecasting a major recession or a major drawdown, but valuations are frothy. So we're looking to see what other things we can do from a portfolio construction perspective that can add some diversification and be complementary to equity market risks, where investors don't necessarily just have to rely on U.S. stocks to really be the growth engine that powers their overall portfolio returns. So now just a quick review of what is expected for 2025. And as we'll see, it's really an extension of the Goldilocks period that we've experienced over the last couple of years. Growth continuing to remain robust, but moderating somewhat. Inflation continuing to trend lower toward the Fed's target of 2%. Another strong year with S&P 500 earnings growth, up 12% year over year. And a valuation multiple, which consensus forecast to still rise to end the year at 24 times earnings. So this is essentially what a soft landing looks like. A little bit slower growth, slower inflation, but that translates into a nice productivity boost, whether it be from AI or otherwise, that is going to allow the multiples of the valuation multiples to extend, really powered by those animal spirits and powered by higher levels of consumer confidence. So a lot of things have to go right in order for investors and the consensus to be proven right. And we think the bar for that is going to be a little bit high in 2025. And a lot of that is largely going to stem from the uncertainty from the incoming administration. There's quite a bit of change in the air, right? Whether that be from a political perspective, whether that be from a policy perspective, what the makeup of the cabinet, what the makeup of the Federal Reserve is going to look like in 2026. So that has led to very high levels of uncertainty. And these are just a couple of charts that we've pulled in. The left-hand side is U.S. Economic Policy Uncertainty Index, which just tracks the overall levels of sentiment and uncertainty. And then we can see on the right-hand side when we focus in on trade as well. That is where a lot of the anxiety has come in the markets. Really, with no one having a really solid understanding of how aggressive the new administration is going to be with these tariffs. Is it going to be a reiteration of Trump 1.0, where the tariffs are used more as a negotiating tool? Or in this new administration, which is in a much different place from a budgetary perspective, are the tariff policies in Trump 2.0 going to have to be used to fund the federal government and help lower these deficits? I think depending on how aggressive he is, and we are with the trade policies, that's going to go a long way toward dictating what the overall returns of the markets and our portfolios are going to do in the upcoming year. And it's not just us that thinks that returns in public markets are likely going to be muted. I put in a graphic that just looks at some longer-term return assumptions from BlackRock, and there's a number of these institutional investors that put out their long-term capital markets assumptions. But what you can see here, the reason I like the way that this chart is laid out is that the assets are coded. So red are going to be your alternatives, green are going to be more your equity oriented assets, and then the yellow are going to be your fixed income. And as you can see, I've got the box covered with equities in the global 60-40 portfolio over a 10-year range. Many of the institutional investors with whom we partner are expecting, again, those more moderate, lower forward-looking returns for equities, kind of in that 6 to 7% range, compared to where we've been accustomed for the last 10 years, more that 10 to 12%. So we think this is really a time that long-term investors who have the ability to incorporate some illiquidity into their portfolios should really start looking to lean into some of these alternative asset classes, which we think can be competitive, and in some years we think will actually outperform the S&P 500. So if you look up at the top of the chart, private equity, highest return expectations of all the asset classes going forward, also very wide dispersion. So this is an area that is very inefficient and certainly where you want to be active. Direct lending, also known as private credit, is another area where we've really started leaning into within our portfolios, where we think over the next 3 to 5 years, you actually might be able to outperform the S&P 500 and do so with much less risk. So these are the kinds of things that we're thinking about from a portfolio construction standpoint, and really where we want to lean in. We've talked about them quite a bit, but if you have not had conversations or not familiar with what we're referencing, please talk to your advisors, reach out, because we do think there's going to be a great opportunity for alternative investments for our investors going forward. And if we look back historically, I mean, the proof is in the pudding. Much longer, if you look back over longer periods of time, 3, 5, 10 years, private equity has outperformed the S&P 500. You focus in and double click on 2022, which was that year where the equity market was down nearly 20%. Bond markets were down 13%. Well, if you had a portfolio which had a portion of it allocated to private equity, a portion allocated to real estate, private credit, you actually had a pretty decent year. And so again, we're not recommending that investors rush out, sell all your stocks. But again, if you have the ability to add some illiquidity into your portfolios, we think these kinds of exposures can be very additive and help lower the overall volatility. So to recap, we'll finish up with our asset allocation dashboard. The way we've actually made a couple of changes to the way this slide is laid out. Historically we focused on asset class. Now we are certainly more focused on purpose. So if you look at the growth drivers, the income drivers, and then diversifiers, we have our highest conviction views in some of the income and diversifier categories. I mentioned private credit, private real estate, more focused on income, we think are two of our highest conviction ideas, as well as making sure that portfolios have nice allocations to diversifiers, things like absolute return strategies, so on and so forth, that are not going to be dependent on what the S&P 500 or the bond market is doing. We want to make sure we've got great representation across many different asset classes and not just focus on those growth equities, though they are always going to have a place in a long-term investor's portfolio. We think the outlook for stocks into 2025 is still going to be positive, but perhaps not as strong as what we've got in the last couple of years. And we really want to lean into some of those alternative and income-producing assets to round out a much more diversified and efficient portfolio.
As always, Cliff, you shared a lot of detail, and you and the investment team continue to stay focused on process planning and patience. We all know that's key. Historically, in every year, we see pullbacks of up to 10%. 2025 may not be much different, as we see increased volatility ahead, whether it be from Washington, the Fed Reserve, or the high valuations I mentioned earlier. We will remain diligent for you, our clients, following our investment process. Well, with us being almost a month into the year, one of the biggest New Year's resolutions tend to be to improve better one's finances. If that was one of your resolutions, let's just take some simple steps. Paying yourself first is key. Maybe pay yourself first through your retirement plan, using your 401k or your IRA. Look to increase those. Maybe you can save through your brokerage account or another savings alternative. Just adding a few extra dollars always helps. Look to save a portion of your bonus. Bonus times tend to be in February and March. Take a look. If you have debt, whether it be your mortgage, car loan, credit cards, you may want to look to pay the highest interest-bearing credits down first. It's a great time to review your taxes. Tax season's just ahead of us, and with the current tax code and the state code, we're not sure what may be ahead, although we do know they are set to expire whether President Trump and Washington make any changes. We'll just have to wait and see. Lots to discuss with your advisor as you meet and plan out your 2025. Cliff and I, as well as the investment team, the Cornerstone Wealth Management team, we all thank you for your time, for joining us today. We'll also share this information on our website, but please feel free to share this with colleagues, family, and friends. If we can be of any assistance to them, share our contact with them. Let us know how we can help. Always happy to meet with them on a complimentary basis to see what their financial picture may look like. Can we be of any assistance to them, or what might they be missing in their financial game plan? Want to wish you all a happy and healthy 2025. Thank you for joining us today.